Chapter 2, a further look at financial statements. Our learning objectives are 1. Identify the sections of a classified statement of financial position. 2. Identify and calculate ratios for analyzing a company's liquidity, solvency, and profitability. 3. Describe the framework for the preparation and presentation of financial statements. Here we're taking a closer look at the classified statement of financial position. The statement of financial position is also known as the balance sheet. It is a picture of a company's financial position, its assets, liabilities, and shareholders' equity at a point in time. The word classified, now this means to put them into different categories. So, for example, here we see current assets, non-current assets, current liabilities, shareholders' equity. Current assets. So, what's an asset? Assets are the resources that a company owns or controls that will provide future economic benefits. The word current assets means assets that are expected to be converted into cash or to be sold or used up within 1 year of the company's financial statement date. For example, cash is an asset. This is something that we are going to be used in 1 year. We also have held for trading investments. These are investments in debt securities such as bonds of another company or equity securities such as shares of another company that are bought with the intention of reselling them after a short period of time. For example, WestJet can purchase their own shares with the intention of reselling them to boost their share price. Accounts receivable. These are amounts sold to the company by customers who purchase products or services on credit. So this is money that we are expecting to receive in the future. So for example, a carpenter does work on your house for $3,000 and you make an agreement to pay him at the end of the month. So that $3,000 is called an accounts receivable in the carpenter's books. Then we have notes receivable. These are amounts owed to the company by customers or others that are supported by a written promise to repay. Notes receivables are normally interest-bearing, whereas accounts receivables are not. Next is inventory. Inventory are goods held for sale to customers. So, for example, inventories consist of goods such as food, clothing, housewares, appliances, and outdoor products. Then we have supplies. Supplies include consumable items like office supplies and cleaning supplies. They are current assets because we expect that they will be used up by the business within the year. Prepaid expenses. Prepaid expenses represent the cost of expenses like rent and insurance paid in advance of use. And they are current assets because they reflect unused benefits such as office space and insurance coverage available for the future use during the year. Non-current assets. Non-current assets are not expected to be converted into cash, sold, or used by the business within 1 year of the financial statement's date or its operating cycle. In other words, non-current assets are not classified as current assets. Examples of these are long-term investments, property, plant, and equipment, intangible assets and goodwill, along with other assets. We'll now have a further look at these examples in more detail. Long-term investments include multi-year investments in debt securities. Example, loans, notes, bonds, or mortgages that management intends to hold to earn interest over the long term. There are also equity securities. For example, shares of other companies that management plans to hold for many years to generate investment revenue or for strategic reasons. These assets are classified as non-current because they are not readily marketable or because management is not intending to sell the investment and convert it into cash within 1 year. Examples of these are shares of other companies. Property, plant, and equipment are tangible assets with long useful lives that are being used in operating the business. This includes items such as land, buildings, equipment, furniture, computers, and vehicles. These items are often listed in the statement of financial position or balance sheet in their order of permanency. That is, land is usually listed first because it has an indefinite life and is followed by the asset with the next longest useful life, normally buildings. Then we have equipment and so on. It is also recommended that you use this order when preparing your homework assignments. Assets that are depreciated should be reported on the statement of financial position at cost less accumulated depreciation. Accumulated depreciation account shows the total amount of depreciation taken to date. It's a contra asset account. That is, its balance is subtracted from the balance sheet of the asset that it relates to. The difference between cost and accumulated depreciation is referred to as carrying amount, and this is also known as net book value, or just simply called book value. Intangible assets. Many companies have assets that cannot be seen, but that are of significant value. Intangible assets are non-current assets that do not have physical substance and that represent a privilege or a right granted to or held by a company. Examples of intangible assets include patents, copyrights, trademark and licenses, also goodwill. Goodwill is an asset that results from the acquisition of another company when the price paid to acquire the company is higher than the fair value of the purchased company's net identifiable assets. Net identifiable assets represents the value of assets less the value of any liabilities assumed as part of the purchase. So it's basically the excess price paid on acquisition of another company. Goodwill is similar to an intangible asset in that it has no physical substance and will generate future value. It differs from intangible assets in that it cannot be separated from the company and sold. So it is determined in relation to the acquired company as a whole. The only way it can be sold is to sell the acquired company. Current liabilities. Current liabilities are obligations that are to be paid within 1 year. So things that we owe. Some common examples of these are bank indebtedness, accounts payable, unearned revenue, bank loan or notes payable, also current maturities of long-term debt. Let's have a look at the definition for these terms. So bank indebtedness is a short-term loan from a bank, typically occurring when a company uses an operating line of credit to cover its cash shortfalls. Also, accounts payable represents amounts owed by the company to suppliers for purchases made on credit. It's sort of like a line of credit. Then we have unearned revenue. So what is an unearned revenue? Money that you've received that you have not yet done the work for. So, for example, airlines receive payments from passengers purchasing tickets in advance of any flights being provided. These payments are recorded as current liability because the airline has an obligation to provide the flight in the future, and this is normally within 1 year. Then there's bank loans or notes payable, and these are amounts owed, often to banks, but also to suppliers or others that are supported by a written promise to repay. And notes payable are normally interest bearing, whereas accounts payables are not. And there's current maturities of long-term debt. When a company has a non-current or long-term note or loan payable, such as a 5-year bank loan, a portion of the bank loan is often repayable each year. So the portion of the loan that is due within the next year is classified as current maturities of long-term debt. The remainder of the loan is classified as non-current liability. So another example, so say if you have a 5-year mortgage, 4 years sits on the long term, and 1 year will be moved to current liability because it is due in the current year. Depreciation. This is an expense to property, plant, and equipment over their estimated useful life. Because these assets benefit future periods, their cost is allocated or expensed over their estimated useful lives through a process, as we see here, called depreciation. Companies calculate depreciation by systematically assigning a portion of the asset's cost to depreciation expense each year. Only assets with finite useful lives are depreciated. So land also contributes to the generation of revenue, but its estimated useful life is considered to be indefinite because the economic benefits represented by land are not used up or consumed. So therefore, land is never depreciated. Non-current liabilities. Obligations that are expected to be paid or settled after 1 year are classified as non-current liabilities, or as commonly known, long-term liabilities. Some examples of these non-current liabilities includes notes payables, including bank loan payable, mortgage payables, and bonds payable. 2. Lease obligations, pension and benefit obligations, also deferred income tax liabilities. Let's have a look at the meanings for these non-current liabilities. So for example, mortgage payables are similar to long-term notes but have property such as land or a building pledged as security for the loan. Bonds payable are used by large corporations and governments to borrow large sums of money. Lease obligations include amounts to be paid in the future on long-term rental contracts used for equipment or other property. Pension and benefit obligations are amounts companies or past and current employees for retirement benefits. Deferred income tax liabilities arise due to differences between accounting and tax treatment and represent income tax related to the current year's net income that is expected to be paid in subsequent. When a company prepares its corporate income returns for those periods. Shareholders' equity. Shareholders' equity is a residual amount. It is the difference between a company's assets and its liabilities. Shareholders' equity is divided into two parts, share capital and retained earnings. Share capital. So shareholders purchase shares in a company by investing cash or other assets. When the company receives these assets, it issues ownership certificates to these investors in the form of common or preferred shares. If preferred shares are issued, in addition to common shares, the total of all classes of shares issued is called share capital. Retained earnings. This is your cumulative net income. So for example, 1 month you make income, next month you make income. When we add it all together, it's called cumulative. So, and retained means that they keep it in the company. Using the financial statements. How do we use the financial statements? Some specific tools can be used to analyze financial statements, such as ratio analysis. So let's define what this is first. Ratio analysis expresses the relationships between selected items of financial statement data. Liquidity, solvency, and profitability ratios are three general types of ratios that are used to analyze financial statements. We will discuss these ratios later on. We also have their used comparisons to aid in an analysis. We have intercompany comparisons, and these cover 2 or more periods for the same company. There are intercompany comparisons. This is between the company and a competitor. And there's industry average comparisons. Now this is based on averages for particular industries. Liquidity ratios. You would use liquidity ratios to look closely at the relationship of its current assets to its current liabilities. Liquidity ratios measure a company's short-term ability to pay its maturing obligations and to meet unexpected needs for cash. So examples of liquidity ratios include working capital and current ratio. Working capital is equal to current assets minus current liabilities, while current ratio equals current assets divided by current liabilities. Higher is generally better. Solvency ratios measures a company's ability to survive over a long period of time. The higher the percentage of debt to total assets, the greater the risk that debts cannot be repaid when they are due. So the debt to total asset ratio is an example of solvency, and it is calculated by dividing the total debt, which is both current and non-current liabilities, by its total assets. Of course, lower is generally better. And the reason for this is that you do not want to invest in a company that has higher liabilities than its assets. Profitability ratios measure a company's operating success for a given period of time. Two examples of profitability ratios include basic earnings per share and the price earnings ratio. Basic earnings per share measures the income earned on each common share. It is calculated by dividing the income available to the common shareholders by the weighted average number of common shares. The price earnings ratio is a frequently quoted statistical that measures the ratio of the stock market price of each common share to its earnings per share. It is calculated by dividing the market price per share by basic earnings per share. Higher is generally better. The price earning ratio helps investors assess how a company's share price relates to the company's earnings.